We're here with Stephen Marks of Fitch Rating, who's going to talk with us about the re-equitization movement in the REIT industry. Do you think that this is a trend that will continue over the second half of 2009 and well into 2010?
We do. The equity raises that were done during the first 6 months of 2009 were done mostly by issuers that needed to raise the capital, not ones that wanted to. So I think four things need to happen, or will likely happen, if we're going to see an increased wave in equity offerings. The first thing is that if the unsecured bond markets continue to be inhospitable to issuers. Secondly, if the asset sales market remains slow and inhibits companies' ability to raise equity. The third thing is if committed amounts under unsecured lines of credit go down, which we anticipate they will. And the fourth thing that will likely happen is if REITs believe that there are opportunities to acquire assets or portfolios or companies for which they think that raising equity is a good source of capital.
And from what you've seen, do you think that REITs are reevaluating how they'll use leverage in the future?
We do. We're seeing that on a couple of different fronts. REITs are looking more closely at the ways in which their lines of credit are structured. And secondly, REITs are also looking at how laddered their debt maturities are, such that an event like we're experiencing now, where there's a significant credit crunch or a dramatic pullback in availability of capital, doesn't hinder companies' ability to finance their businesses. So laddered debt maturity schedules to make sure that companies have access to different forms of capital, whether or not it's equity capital, joint venture capital, unsecured debt, and secured debt, are things that I think a lot of companies have an increased focus on, given that liquidity is of primary concern in this environment.
How about on the lending side? Once financial markets settle down, do you think that lenders will be a little bit more stringent in how they issue debt to REITs?
We think that they will. In fact, over the last 12 months or so, because of the significant dearth of debt capital available to borrowers, lenders have been able to dictate terms, and they're dictating terms such as amortization, partial recourse, front-end fees, back-end fees, and an overall increased cost of capital to provide secured debt. And on the unsecured side, what we're seeing is that, and what I think we're likely to see over the next 12 to 24 months, is that on the unsecured side, commercial banks are going to increase costs to REITs and maybe incorporate some factors such as LIBOR floors. So I think that secured debt capital and unsecured debt capital is going to get much more expensive for REITs.
Thanks for your time, Stephen. For more information on this and other REIT news and analysis, check out REIT.com.